Investment tips for beginners. Investment decisions should be based on your personal financial situation, goals, and risk tolerance, and it's always recommended to consult with a licensed financial advisor before making any investment decisions. However, I can provide some general tips that may help you make more informed investment decisions. Diversify your portfolio. It's important to spread your investments across different asset classes, sectors, and geographies to reduce your overall risk exposure. Diversifying your portfolio means investing in a variety of different assets, such as stocks, bonds, mutual funds, and real estate, across different sectors and geographic regions. The goal of diversification is to reduce your overall risk exposure by spreading your investments across multiple asset classes, rather than relying on just one or two investments. For example, if you only invest in technology stocks and the tech industry experiences a downturn, your entire portfolio could suffer significant losses. However, if you also have investments in healthcare, energy, and consumer goods, you may be better protected from market volatility. Diversification can help you achieve a balance between potential returns and risk. By diversifying your portfolio, you can potentially reduce the impact of market downturns on your overall investment returns, and achieve more consistent returns over the long term. Focus on long-term growth. Investing for lifetime wealth means thinking long-term. Focus on companies that have a strong track record of consistent growth and are well-positioned to continue growing for many years to come. Focusing on long-term growth means looking for companies that have a strong track record of consistent growth and are well-positioned to continue growing for many years to come. When investing for lifetime wealth, it's important to think about the long-term potential of a company, rather than just short-term gains. When evaluating a company's growth potential, consider factors such as market size and growth potential. Look for companies operating in large and growing markets, as this can create opportunities for sustained growth over the long term. Competitive advantages. Invest in companies that have a competitive edge over their peers, such as a strong brand, unique technology, or a dominant market position. Financial stability. Companies with strong financials, such as solid cash flow, low debt, and a healthy balance sheet, are more likely to weather economic downturns and continue growing over the long term. Management team. A company's management team can have a significant impact on its long-term growth potential. Look for companies with experienced and capable leaders who have a track record of delivering results. It's also important to remember that investing for long-term growth requires patience and discipline. The stock market can be volatile in the short term, but over the long term, it tends to reward investors who stick to a well-thought-out investment strategy and focus on quality companies with strong growth potential. Consider the company's competitive advantages. Look for companies that have a competitive edge over their peers, whether it be through proprietary technology, strong brand recognition, or a dominant market position. Considering a company's competitive advantages is an important factor to look for when evaluating investment opportunities. The competitive advantage is a unique feature or advantage that sets a company apart from its competitors, and allows it to maintain a profitable market position over time. Some common types of competitive advantages that investors look for include strong brand recognition. Companies with a well-known brand name and positive reputation can attract loyal customers and charge higher prices for their products or services. Proprietary technology or patents. Companies with proprietary technology or patents can have a significant advantage over their competitors, as it can be difficult for others to replicate their products or services. Economies of scale. Companies that can produce goods or services at a lower cost due to economies of scale can often offer lower prices than their competitors, which can be attractive to customers. Network effects. Companies with strong network effects, such as social media platforms or online marketplaces, can benefit from increased usage and engagement as more users join the platform. When evaluating a company's competitive advantages, it's important to consider how sustainable they are over the long term. A company that has a strong competitive advantage today may not be able to maintain that advantage if competitors catch up or if the market changes. Investors should look for companies that have a durable competitive advantage that is likely to remain strong over time. Pay attention to valuations. While growth is important, it's also essential to ensure that you're not overpaying for a stock. Look for companies that have reasonable valuations relative to their growth prospects. When investing, it's important to pay attention to the valuation of a company, which is a measure of its worth or value. The valuation of a company is based on various factors, such as earnings, revenue, growth prospects, and market conditions. The goal is to find companies that are undervalued, or trading at a lower price relative to their intrinsic value. To evaluate a company's valuation, you can use metrics such as the price-to-earnings (PE) ratio, price to sales, PS ratio, and price to book, PB ratio. These metrics can help you understand how much you're paying for each dollar of earnings, sales, or book value of a company. When investing for lifetime wealth, it's important to focus on companies that have reasonable valuations relative to their growth prospects. A company that is trading at a high valuation may be overpriced, and the potential for future returns may be limited. On the other hand, a company that is trading at a low valuation may be undervalued, and could potentially provide greater returns over the long term. It's important to remember that valuation metrics should be used in conjunction with other factors, such as a company's growth potential, competitive advantages, and financial stability, to make informed investment decisions. Ultimately, investing is about finding the right balance between risk and reward, and selecting companies that have a strong potential for long-term growth while being traded at reasonable valuations. Stay informed. Keep up to date with news and developments related to the companies you're invested in, as well as broader market trends and economic indicators. This will help you make more informed investment decisions over time. Staying informed is a critical part of investing for lifetime wealth. As an investor, you need to keep up to date with the latest news, trends, and market developments to make informed investment decisions. Here are some tips to help you stay informed. Read financial news and analysis. Subscribe to financial news sources and publications to stay up to date with the latest news and analysis on the companies and industries you're interested in. Follow market trends and economic indicators. Keep an eye on key economic indicators such as inflation rates, interest rates, and GDP growth, as these can impact the overall market and individual companies. Attend investor conferences and events. Investor conferences and events can be a great way to learn about new investment opportunities and network with other investors. Use social media. Social media platforms such as Twitter and LinkedIn can be a great way to stay informed and connect with other investors. Consult with financial professionals. Consider working with financial professionals, such as financial advisors or brokers, who can provide insights and guidance based on their expertise and experience. Regularly review your portfolio. Regularly reviewing your portfolio can help you identify areas where you may need to adjust your investments based on changes in the market or your financial goals. By staying informed and regularly reviewing your investments, you can make informed investment decisions that can help you achieve your long-term financial goals. Remember, investing always carries some degree of risk, and past performance is not a guarantee of future results. Always do your own research and consult with a licensed financial advisor before making any investment decisions. To learn more about life, business, and technology, subscribe to this channel. See you on our next video.